FHA loans continue to be one of the most popular loans for first-time homebuyers, and for good reason. With its low down payment requirement and more flexible underwriting guidelines than their conventional counterparts, it makes perfect sense why the FHA loan helps more renters become first-time homebuyers. And so on this video, I'm going to be giving you guys the 23 things that you didn't know yet about the FHA loan. Coming up. What's up guys, welcome back to the channel. My name's Caton, I'm a loan officer in San Diego, California, and on this channel, I help people just like you learn how to buy their first home and navigate the mortgage process. Now as always, if you have any questions during this video, make sure you leave them in the comments section down below. I'll be happy to hop in and answer them, and links to anything that I mentioned will be in the description along with the time cards. So that being said, let's just jump right on in. All right, number one. Believe it or not, the FHA actually doesn't have a legal minimum FICO score. However, they do set limits on the down payment depending on your FICO score. Now, if your FICO score is 580 or above, you'll be able to take advantage of the FHA's 3.5% down feature. However, if your FICO score is below that, you're going to have to bring in a minimum of 10% down. Now that being said, some lenders do have a minimum FICO score overlay on those guidelines. So you want to check with different lenders if your FICO score is a little bit lower to see who can actually help you get an FHA loan. Now moving on to number two, like I said, there's no minimum FICO score requirement. So some lenders actually offer no score mortgages for FHA loans. Now that being said, because you're not using a traditional FICO score, they're going to look at some sort of alternate trade line, whether that's your phone, your rent, some utility bills, anything else that they can look at instead of looking at a credit report. Now keep in mind, these no FICO score options, while they exist, usually have higher interest rates and a higher down payment requirement. So just keep that in mind. Moving on to number three, the mortgage insurance premium actually changes with the down payment that you're putting down. Now there's a lot of different levels of this, so I'll put the chart up, but as you can see, depending on how much you were putting down, the mortgage insurance premium can actually change based on that, as well as if you're using a 30-year or a 15-year mortgage. Another great thing to note as well is the duration of the mortgage insurance. Now, while most people will tell you if you are putting 3.5% down, the mortgage insurance is for life, you'll see on some of these options that it can actually fall off after 11 years, depending on how much you're putting down. Interestingly enough, it's also based on the loan amount as well. So make sure you're keeping an eye on that loan amount as well as your loan to value to figure out how much your mortgage insurance premium is going to be. Alrighty, number four. Now, while you already know probably about the most common FHA loan, the 203B, which is typically used for refinances and purchases, there's actually a few more FHA loans that are out there. There's also the 203K, which is known as the Renovation Loan, the HECM, the Home Equity Conversion Mortgage, or a reverse mortgage offered through the FHA. There's also energy efficient mortgages, as well as the Section 245A mortgage, which is a graduated payment mortgage. Now, if you want to learn more about how these mortgages work, I've left a link in the description below because it's going to take way too much time. We'll save that for another video. But on that note, moving on to number five, the 203K mortgage. It's actually a mortgage that you can use with an FHA loan, whether you're doing a purchase or a refinance, to actually make improvements to the home while you're in process for that home loan. And as bonus number six, the 203K comes in two different flavors, the 203K Standard as well as the 203K Limited. The biggest difference between these is how much you can actually borrow, as well as some of the requirements and guidelines on how it's going to be underwritten. Typically with a limited 203K, you're limited to up to $35,000 in repairs, whereas for larger projects, you would probably want to look at the 203K Standard mortgage, which lets you finance way more than that. Once again, I've left a link in the description below so you can take a look and see how those different products vary. Alrighty, number seven. So while the FHFA has their own guidelines for loan limits every single year, the FHA, which sounds similar but is completely different and separate, has their own limits for FHA loans. And these limits vary depending on whether or not you're in a high or a low income area. But following suit with conforming limits, the maximum loan amount does change whether you're buying a 1, 2, 3, or 4 unit property. So if you're considering buying a home with an FHA loan, make sure you're taking a look and considering your area's FHA loan limit as is compared to the conforming loan limit. Now speaking of limits, moving on to number 8, as opposed to its USDA counterpart, the FHA loan actually doesn't have income limits based on your area. So despite having different loan amounts for low or high income areas, there's luckily no income limits for the FHA loan. All right, number 9. While we know the FHA loan is very flexible when it comes to things like FICO score, you also should note that FHA loan is a lot more flexible with debt to income ratio as well, specifically the back end of the debt to income ratio. Although the FHA loan is pretty conservative with its front end ratio or housing expense ratio, its overall or back end ratio is actually the most flexible other than the VA loan, with a maximum debt to income ratio allowable of up to 56.9%, with AUS approval. This is just a fancy way of saying that your loan officer is going to have to run automated underwriting to make sure that your higher debt-to-income ratio will still be acceptable considering all the other risk factors. Number 10, unfortunately with FHA loans, one downside is that you can't just go out and buy any old property. In fact, if you're buying specifically a condo, you have to get one from a specific condo complex that's been approved by the FHA. Now, once again, you can take a look at the description below to search if the condo that you're looking at is FHA approved. But you'll want to work with a lender because some of these condos don't always show up by name. Now, that being said, that brings us to number 11. The FHA has actually made this process a lot easier because instead of getting the entire condominium complex approved like you used to have to, you can actually get a spot approval for your specific condo. Now, that being said, I've tried to do this with a few clients. It's a very long process and probably isn't really worth the time and effort spent doing it because it's essentially a coin flip. But that is an option out there for you if your condo that you're looking at isn't yet FHA approved. In addition to condos, the FHA doesn't really want you buying flipped homes as well. That's why the FHA has what's called the 90-day flip rule. Essentially, you can't buy a home using FHA financing if the home was previously bought in the last 90 days. Now, once you're outside of those 90 days, you're pretty much good to go. But just make sure you're keeping that in mind if you're using an FHA loan and looking at homes that have probably been flipped. Now, moving on to some better news for properties. Number 13, the 3.5% down rule actually doesn't just apply to primary single-family residences or condos. You can also use the 3.5% down feature for multi-unit properties as well, up to a 4-unit property. Now, the caveat is you have to live in at least one of the units as your primary residence. Now, you got to move into that unit within 60 days of buying the property and live in it for at least a year. But you can go ahead and rent out those other units and still take advantage of the 3.5% down feature, which is a huge difference from the typical 15% that a conventional loan would require. Now, if you have an FHA loan right now and you're trying to refinance just to get a lower rate, the FHA actually has a great option for you called the FHA Streamline. This program essentially allows you to get into a lower rate without having to prove any income, assets, or even get an appraisal on the home. Now, that being said, the biggest caveat here is that all of the closing costs have to be paid outside of closing. They're only going to streamline your existing loan amount, which is good because your loan balance isn't going to go up, but also kind of bad because you got to pay those closing costs out of pocket instead. Now, what about if you're trying to refinance and get a little bit of cash out? Well, unfortunately, the FHA has pulled back a little bit on cash out refinance. It used to be that you could finance up to 85% of the loan to value, but recently they've pulled that back and now you can only finance up to 80% of the loan to value, basically matching the same as a conventional loan. Now, I bet you didn't realize that you can actually have more than one FHA loan at a time, but there's a catch. If for whatever reason your job requires you to up and move and relocate to a different city, you don't necessarily have to sell your existing home with an FHA loan to get a new one. In fact, you can keep that FHA loan, rent out that property, and buy a new primary residence in that new city as long as it's at least 100 miles away and close enough obviously to your new work location, and claim that as your new primary residence, and essentially have two FHA loans at the same time. Now, if you've had a bankruptcy recently, it doesn't necessarily disqualify you from getting an FHA loan. In fact, you can get an FHA loan much sooner than you would if you got a conventional loan. Now, if you had a Chapter 7 bankruptcy, the wait period is 2 years as opposed to conventional's 4-year waiting period from the discharge date. And if you had a Chapter 13 bankruptcy, you only need to prove that you've made 12 payments on time of your court-ordered repayment in order to qualify for an FHA loan. This means despite rebuilding credit and despite having those bankruptcies, as long as you meet those requirements, you can get into a new home pretty quickly. Now, while FHA loans are pretty flexible when it comes to other credit events, the one place where it is a little bit tighter than its conventional counterparts is student loans. Now, when calculating student loans towards your debt-to-income ratio, as long as you're on a fully amortizing student loan repayment plan, we can go ahead and use the payment that you're already making. But for most people, that isn't the case. So if you're either in forbearance, deferment, or on an income-based repayment plan with your student loans, the FHA's 1% rule kicks in. Essentially, we take the outstanding balances of all the student loans that you have and apply 1% to that and use that 1% as your qualifying monthly payment. Now, as you can imagine, for somebody who has a lot of student debt, this can mean your debt-to-income ratio can shoot up a lot higher than what you're actually making as a monthly payment. So unfortunately, if you have a lot of student debt, using an FHA loan could be pretty prohibitive, especially if you're not in an amortized payment plan. Now, a great hidden feature of FHA loans is most FHA loans are actually assumable. This means that if your home seller has an FHA loan, you can come in as a buyer and assume that loan if it has better terms. So for example, with someone who has better interest rates, if the seller of the home had an interest rate of 2.5 on the FHA loan and rates are currently at 3.5, you could technically assume their FHA loan as long as you meet the other qualifying requirements. Now that being said, of course, if you're buying the home, you're gonna have to make up the difference between their existing balance and the purchase price, which could mean a much larger down payment. The bright side, however, is you're gonna get a much better interest rate, especially if rates are gonna continue to rise as they are right now. Another great feature of FHA loans is they can be paired with most local down payment assistance programs. In fact, the FHA loan is probably the most common loan to be paired with a down payment assistance program because of the 3.5% down feature. So where the 3.5% down requirement from the FHA is there, that's where the down payment assistance comes in to help you cover most, if not all of that down payment and a little bit of your closing costs. So make sure you're taking a look at your options when you are weighing down payment assistance programs. Some offer conventional and FHA financing. Make sure you take a look at both. Another bright spot of FHA mortgages is they tend to have typically lower interest rates than their conventional counterparts. That being said, the two-part mortgage insurance, the monthly and the upfront mortgage insurance that gets financed into the loan, can mean that you might have a higher payment than you would with a conventional loan. Now that being said, you should probably still consider your options between an FHA loan and a conventional loan, especially if your FICO score is under 700. This is because FHA loans backed by the government are not as volatile when it comes to FICO score as conventional loans are. Also, the mortgage insurance premiums on conventional loans has a lot to do with your FICO score as well, versus FHA loans, which is based on the loan to value, like we talked about at the beginning of this video. What if you have things like collections or disputes on your credit report? Well, this is one of those gray areas where it depends. Now, if any of those collections or disputes are related to medical debt, we can completely ignore this. Now, while typically if your collections amount to over $2,000, typically most lenders will say that you have to pay those collections off before closing. However, that's not actually the case. In fact, the FHA has a 5% rule for collections that you can use 5% of the existing balances and count that towards your debt to income ratio. And as long as you still qualify with that 5% monthly payment, you're good to go without having to pay them off. Now, when it comes to disputes, like I mentioned, if it's a medical debt, you can go ahead and exclude those. But for any other kind of debt, those disputes have to be removed before closing because those can technically trick the FICO score algorithm into giving you a higher FICO score than you actually have. So if you have any disputes on any of your credit lines, make sure you have those removed prior to your loan officer getting you pre-approved. That way you have an actual idea of what your FICO score really is. And most importantly, if you are delinquent on any sort of federal debt, and this includes federal student loans, unfortunately, you're not going to be able to be qualified for an FHA loan until those are completely paid off. And lastly, number 23, ending on a good note, as of January of 2021, if you have DACA, if you are a DACA recipient, you're actually eligible now for an FHA loan after not having been eligible for such a long time. Which means if you've been watching this video so far, anything and everything that I've talked about applies to you as well. So that does it for my list of the 23 things that you probably did not know about FHA loans. Actually, while putting this video together, there were a few things that I learned as well, and I do this for a living. So if you want to learn more about FHA loans or just how to buy your first home, check out some of these videos that can really help you out, especially if you're a first-time home buyer. And if you like this video and you want to see more videos just like this one, make sure you hit that subscribe button. It would mean the world to me. And make sure you ring that bell so you get notified every time I post a new video. But that does it for this one. If you have any suggestions on some content that you want to see, make sure you leave it in the comment section down below. Until then, I'll see you next time. Bye.